Federal Reserve Fed in US has recently done interest rate hike, pushing the interest rate from 4.75 to 5%. Fed is pursuing one of the aggressive interest rate hike policy in the 40 years history. Immediately after the interest rate hike, the value of the bank's bonds in US it has fallen, and many started feeling that this is going to worsen the banking crisis and in turn push the US economy into recession. In this video, let's see why Fed is doing so. If there is any banking crisis, how deep is it and what are the reasons for it, and will it impact India? Recently, the trading in the shares of two more regional banks in US, that is PacWest and Western Alliance, had been halted. So this is definitely major cause of concern in the wake of failure of 16th biggest bank, that is SVB, right, which had sent tremors across tech startups. And this was followed by collapse of other banks as well, First Republic, Signature Bank, etc. Now, if you see, there are more than 4,000 banks which are functioning in US. These might witness this kind of merger, amalgamation, total consolidation, but this definitely shakes the confidence of investors and customers because 95% of Americans have bank accounts. So this is definitely not a good news for them, right? If you observe the characteristics, they are quite same. They have heavy exposure to the bonds which were issued by US government. They had literally no risk management plan in place in order to address liquidity concerns. That's why when such concerns started rising, they ended up selling these bonds at loss. So why these kind of incidents are happening? There are two primary reasons which are leading to this kind of bank failures. One is inflation, second one is interest rate hike by Fed. Let's analyze this inflation part. When inflation goes up in an economy, this also increases interest rate risk for banks, which in turn affects their depositors' behavior, loan recovery, as well as investment. We all know how it impacts loan recovery, right? Whether it is business or person, if he has taken loan and under inflation, if he is struggling to make decent amount of profit, the probability of getting the loan back or loan recovery for the bank is also not going to be easy. Talking about the next part, that is investment of these banks. In US, banks have taken heavy exposure to the bonds which are issued by US government. So this worked well and had given steady, stable return in the past. But situation changed when Federal Reserve went on increasing the interest rate hike. Let me tell you with an example. If Fed is issuing, say, the bonds at 8% right now and probably had issued the bonds at 5% 2 years before, as an investor, which one will you prefer? Definitely the one which is getting issued right now, right? So, these banks which have subscribed to the bonds which were issued 1 year or 2 years before saw the value of the bond portfolio declining once the Fed started interest rate hike. Now, everything would have worked well in their favor if they could have sat over this loss, which is notional in nature. Because unless and until they are acting and materializing this notional loss by pressing the selling button, nothing will happen. But they did not do so. Since they did not have this kind of diversified investment into other asset class, primarily went on focusing on taking lot of exposure to the US government bonds, they had to sell it off when they started getting depositors' request of withdrawal. Now, how inflation affects depositors' behavior? Just think, as a depositor, if we are getting lot more interest rate by the short-term bonds which are issued by the government, who will turn towards a bank and keep the deposit? Even the person who has kept the deposit will probably go to the bank and try to withdraw that and invest in the short-term debt securities which are issued by the government, right? The same thing has happened in US, but when the bank started getting this kind of depositors' request, they had no plan B in place. They went on exiting, selling the bonds in loss. Second one, Fed interest rate hike. Post Post-COVID, Federal Reserve in US, in order to boost demand in economy, went on decreasing the interest rate and brought it down close to zero. This has increased the money supply in economy. So this kind of excessive liquidity made banks to see surge in deposits. So they went on accepting the deposits and investing this major proportion in the US bonds, which was stable asset class and gave predictable, stable return at that time. So everything went on working well for everybody 2 years before. But later on, this kind of excess money supply or liquidity in an economy, as well as supply shocks induced by Russia-Ukraine war, sent the energy and other prices of the commodities to the sky. So now the situation started turning against everybody. If you want to know the severity of this shock or understand how Fed rate hike can impact the balance sheet of these banks, let me tell you, recently, after Fed has increased the interest rate from 4.75 to 5%, FDIC in US itself had confirmed that it can potentially wipe out $2 trillion worth of equity in the balance sheet of US banking sector. Why? Because there is already $620 billion worth of unrealized loss sitting in the balance sheet of these banks. Now we know how the interest rate by Fed causes the decline in the value of the long-term bonds, right? Applying the same logic, there has been the notional loss of $620 billion in the balance sheet of this banking sector. Now you might be thinking, definitely Fed knows what is happening in the banking sector. So when the banking sector is reeling under the pressure, why is it aggressively pursuing this kind of interest rate hike? Simply because it has to achieve target rate of 2% inflation. Now the next question is, who has given this target rate and how it becomes target rate, right? There is an interesting story behind it. It has its roots in New Zealand. In 1989, New Zealand had decided that we should have a target inflation rate, a sweet spot where consumers are also comfortable and economy is also flourishing. So one economist said, it can be zero. It cannot be zero, right? At that time, economy will stop growing and nobody will spend anything in an economy. So another person said it is 1, and then mutually they agreed that the target rate can be 2%. So later it was adopted by Australia and other countries also followed. But US had never subscribed to this idea of target rate because it always felt it depends on circumstance. And it is true also to a certain extent. What is relevant in 1970s may not be relevant in 1980s, and the situation, circumstances can be completely different in 2023, right? So US never had this kind of target inflation rate in its mind till Alan Greenspan came and assumed the power. When Alan Greenspan became Fed Reserve Chief, he also felt that we should have a benchmark for inflation, because that's how we understand whether the prices of commodities are increasing generally or they are increasing at an alarming rate. If it is the second case, then it will be a pressing point for us to consider taking any policy actions. So unless and until you have a target in mind, you will never know what is happening in an economy. Many people did not subscribe to this idea, and some argued against it, some were in favor of it. Finally, a renowned economist called Allen could convince others, and he said, yes, we should have a target or a benchmark inflation rate. It's very much essential for having price stability in an economy. That's how this 2% target inflation rate got enshrined in Fed policy. And that had also, undergone a lot of changes. In 2020, Fed had decided that 2% inflation rate is not absolute figure. It's not that at all point of time we should be moving only at 2% inflation rate. No. But considering a particular time period, the average of the inflation rate should be 2%. Inflation rate, that is CPI rate in America, has reduced. It has come down from its peak, that is 8.5% in 2022 to 5% now as on March 2023. So don't you think that it is a time for Fed Reserve to consider going little slow with respect to its interest rate hike and slightly push the target rate of inflation more than 2%, at least to 4%, because the circumstances which are prevailing right now in an economy is completely different. Why it matters? Because the last thing that Fed will ever wish to US economy is to have credit crunch situation. What is credit crunch situation? When banks cannot function with deterioration in value of their bonds portfolio, equity as well as deposits, they will struggle for survival and they will start curbing the lending. That means there is no access of credit to the business or to the people. And it is not at all a healthy sign for any economy considering its growth. Let me tell you, 39% of commercial real estate debt in US is held by small and regional bank. Now, if the real estate price starts crashing, who bears the brunt of it? Again, these regional banks, right? Look at this chart. This chart shows the relationship between the credit growth as well as economic growth. So if credit growth turns negative, eventually even the economic growth of that country also becomes negative. Will this banking crisis in US impact financial market of India also? Definitely no, because we have extremely well regulated financial market, and if you consider the capital adequacy ratio, our public sector banks, they have 12% and the scheduled commercial bank, they have 9% of capital adequacy ratio, which is above the prescribed limit of 8%. So definitely this will not have any kind of adverse effect on the banking sector in India. The last but not the least, will this banking crisis push the country into recession? Let me tell you, in America, even the capital market is equally vibrant. So as long as other parameters are under control, recession will definitely be a distant reality. But this banking crisis will not end as long as Fed is keeping on increasing the interest rate and clinging on to achieve this outdated version of 2% inflation rate. At the end, it is actually in the hands of Federal Reserve, because it is the Fed which will decide to what extent it is going to inflict pain in economy. Does it want to slightly tighten economy by keeping it under actual growth potential and go like tsunami by aggressively hiking the interest rate and push it into recession? Final call rests with Fed. What do you feel about this? Will this banking turmoil lead to recession? Let me know your views in the comment section, and if you like this video, please don't forget to subscribe.